State your name, tell us a little bit about yourself. We might have plenty of time to do that.
It's
So
coming.
Okay,
there we go.
that
Apologies.
was quick, you know, you panic at the last minute.
Of course.
Again, I'm Jack Bardall. I'm the current chair of the Finance Committee, and I'll be going through the presentation today. I just want to go over the highlights of what we're going to be covering, as you see here on the screen. I'll be reviewing who the Finance Committee members are, you know, two of which are up here with me. We'll be reviewing the, and we have a third who has just showed up. I'll be reviewing the performance, the actual versus the budget. And we'll be talking about our forecast. We have implemented something different this year and have a new forecasting tool that will forecast out the next 3 years. And then we're going to talk about, I'm going to talk about the allocation methodology that was used. Wait a second, we're really here. Allocation methodology that was used for allocating the assessments this year, which was different than previous years. And then we're going to talk about, I'm going to talk about the revenue challenge we've got coming up. We've got a couple major events occurring that is going to challenge our revenue. And lastly, something that is why I have in all caps, cash. So we're going to talk about cash, because at the end of the day, it all revolves around how much cash any entity has. So the committee, myself, Jack Bardall, Rick Yale, former. Rick is, I'm going to take care of the forecasting part of things for 2025. Rick Yale and John Shea, our newest member of the committee, are going to be focused on balance sheet reviews and income statement reviews. Dick Hogarth is overseeing insurance and security. Gabe Dagan, who is here, he does landscaping and irrigation, which only consists of about 30% of our budget. Roger handles the L&N contract, looks at trash and cable. And Marco Pila, he handles our investments, which is pretty critical for us right now. We're going to review the 2024 highlights. The 2024 actuals, the pre-audit. These are pre-audited numbers to budget. And I want to talk about what the Finance Committee accomplished. The new allocation method, which was developed this year by Mike Palmer and Gabe Dagan, was very critical in determining what we determined to be fairer assessments and a fairer allocation methodology. I will have you know that the net result of that was that nobody on the Finance Committee received any benefit from that. So it was truly unbiased. It was largely people in townhomes, we determined, and there were a lot of extra hours put in to this by the committee members and Veronica to make this, to put this together. Our 3-year forecast, we're going to show you. I'm going to show you some of that. This is the first time we've done that. But with some of the events occurring, it's important that, we look forward. What's behind us is done. We can't do anything about yesterday, but we're going to start looking at, in more detail, the future and how things look there. Our audit this past year, in 2024, was completed 3 months earlier than the previous year. So some heat was put on our outside auditors to make, push things up and be more timely with us. The service gate, it's open, it's finished, but on the financial terms, initially the quotes were, the estimates were for anywhere from $800,000 to $1 million to put that in. The actual came in at 700,000, so it came in significantly less. But even better than that, the excess operating, funds from 23 and 24 completely paid for the service entrance. In other words, we didn't have to dip into cash to pay for this. So that was quite an accomplishment. And Roger here was on the finance committee, was the guy monitoring that throughout the process. Some of the accounting things we did that, like new procedures to implement reconciling fund balances to make sure that the operating and reserve funds were properly stated. So, that was accomplished in 2024. And here are, here's a summary of how we, came out compared to our budget. Now, you see other income, the second line item down, we were ahead by $271,000. All of that came from capital contributions. Capital contributions is the half of 1% that is paid at closing to the PCA for the sale of a home. And clearly, we under budgeted that. And that number really came from our friends at Ocean Atlantic, who underestimated their home sales for 2024. So we exceeded that by $270,000. In addition, we had budgeted prior to balance the budget, bringing in prior year income or cash from the prior year. We didn't need to do that. So we didn't. Contracted services, they came in $193,000 less than budget. $100,000 of that came from landscaping alone, with the rest, the other $90,000 spread among, all the other contracted services. Insurance, admin costs, we were off by $40,000. Insurance, we got a significant bump in our insurance. That was the direct result of one insurance claim and the reserve set up for that claim, which was $40,000. The good news, that has been closed and settled. So we are, bidding out our insurance this year, and we will be looking for our insurance premiums to come back down. At least that's our expectation, at least for the liability stuff. Anything on property, we all know, you watch the news and you see what's happening in California, you see what's happening in what happened on the East Coast, in the Carolinas. Property insurance, will be going up. However, we don't have much in the way of property. We have the nature center and we have the front gate and the guard shack for property. But we have other things we have to insure, like the open areas, little thing called trees, and we have to insure those. A good hurricane, can really decimate, our landscaping and trees here. Electricity came in, a little higher. That seems to be a problem throughout the state right now with higher electrical rates. And then here we budgeted on the service entrance, the new entrance, we budgeted $98,000 in costs being absorbed. We paid $414,000. So we covered the balance. The rest of it had been paid earlier in 2023. And as you see, we had budgeted, we always budget to break even, a zero-based budget. As our pre-audit number is, $17,000 deficit. So overall, these are great numbers. I would have loved to, when I was back in the Fortune 500 and had to make presentations like this to, the corporate weenies, I would have been very happy, making one like this,
With all due respect to any corporate weenies in the office, in the audience today.
Well, I was one of you at one time, so. And now moving on to 2025. The good news is 2024 was we consider financially, we had a good year, a very good year. For 2025, what I'm going to talk about is the 2025 highlights, what we intend to accomplish, the budget comparison for 2025, and we're going to look at 23 through 28, which includes the 3-year forecast. For 26 to 28, we made some assumptions. One, that inflation will run at 4%. And, we have a contract with Zato, and we know the landscaping is going to be 6, 3, and 3. So we have those fixed increases coming in 26, 27, and 28. And currently, right now, the reserve study, which, I'll ask Veronica to fill us a little in because they just did their walkthrough this past week. We're having a new reserve study done. And, and right now, the forecast includes the old reserve study numbers. So that's what we had, that's what we used. However, we do expect our the reserve study to show an increase in cost, replacement costs for everything in the community. This was studies done every 3 years, 4 years?
Every 3 to 5 years. We did stretch it out this time in anticipation of Peninsula Service Road being built, and then we figured let's get that built and add it into the study, as well as we have the final pave done now in all of the communities with the exception of Stillwaters. So we did stretch it out to 5 years this time so that we could get all of those completed and into the study as final paved projects.
It was done in
2021.
21 replacement costs.
Yeah.
Now we're talking 25 replacement costs.
Exactly.
We'll see what impact that has.
So I would expect that, construction costs spiked and then came back down, but they never came back down to 22 or pre-COVID levels. And I know that I have 6 clients I still work with, all manufacturing companies. 3 of them serve it. Their products go into construction, the construction world. And I can tell you costs have come up significantly. They have come down a little, but we're anticipating that, our reserve contributions are going to have to be increased. But that is not in this forecast. Yeah. Do we have a timing for them to turn this around?
I don't have that yet.
Okay.
No, they did, like you said, just did the walkthrough and taking that information back, and they'll plug it all into the computer and get that to us. They do take into account the money we have in the bank and the active investing that we're doing. So all of that will be part of their calculation.
Right. I'm going to talk about the allocation methodology that, Gabe and Mike Palmer, set up. Summary of assessments by the neighborhood and home type. And that's the big change that happened this past year, home type versus, neighborhood itself. And then I've got some charts that are going to look at our assessment revenue and our other income revenue. And the other income revenue is largely the capital contributions. And you'll see visually the dramatic shift, that is going on here. I've already talked about the reserve study, and that's going to drive our cash requirements. We're planning for a significant decrease in our capital contributions. Our forecast call for Ocean Atlantic to finish Stillwater this year and close it all out. So we'll be starting 2026 basically with, a full community. It's going to be 1,200, and I think it's 51 units when we're all built up. Insurance I mentioned is going to be bid and coverages reviewed. We'll do we're going to update our forecast once a quarter. for the current year, for 2025. So at the end of March, we're going to look at this in April and reforecast out. If you don't know, we've kind of exceeded our budget for snow removal. I mean, we budgeted 50, which was a 3-year average. The latest numbers were at 120,000. So we've kind of missed that one a bit. We'll work on budgeting and continue with the cash management. Now for the data, as you know, I have 23 and 24 here, along with the 2025 budget, our forecast for 26, 27, and 28. In 23, we generated $245,000 in excess money. In 24, I mean, all my fellow members of the Finance Committee pointed out that this was different than the other slide, which showed minus 17. This is minus 18. Rounding error. The budget, as you can see, is zero-based. We have $100,000 that we forecasted in there coming in from the prior year. And then as we go out into future years, the assumption here for assessments is a 4% increase. And with that, you can notice that in 26, we have 181,000 required to make up the difference. 27, 104, and 28 is 111,000. So it's a rough forecast. Don't take any of this to the bank, because that's why you call it a forecast, because it changes. But we're trying to give ourselves an idea of what we can expect, moving forward, and what additional plans we have to make. And the change in allocations. Again, Mike and Gabe and Veronica and others on the committee, there was almost 30 hours plus spent making sure that this all made sense. We went back and forth. I mean, Gabe and Mike set up the parameters. Then it came down to doing the allocations. We came back to the committee and refined them even further. The costs that are allocated, there's only $1.4 million that's allocated by departments in a different, by neighborhoods and housing types. The rest is allocated straight individual homes. Trash, for an example, windswept 18th on the Bay, they're excluded. They have their own trash pickups, they're excluded. Landscaping, irrigation repairs, that's where the bulk of the allocation comes from. And we did get some input from Spazzato that was basically pretty useless, for what we were trying to do, and basically how they do their costing and pricing. But I think we came up with a fairly fair allocation. And L&N costs, those costs by neighborhoods. Some of the neighborhoods, particularly where I live in the Veranda, we don't use L&N. We use Seascape. So we don't get an allocated cost for L&N, and some of the condo associations do not either, because they use somebody else. Now here is all the detail of the assessments. You can see, if you look down the increases, the bulk of them are in 4% range, and then a few that are virtually nothing or a little less. Those largely are townhomes. The townhomes were being over-assessed on the landscaping. And that's where the allocation logic, really played out and showed that, it wasn't fair. You look at, a townhome was getting basically a landscaping assessment similar to a house in Lakeside. So it didn't make sense. And I think what we came up with was pretty fair and equitable. And again, disclaimer, nobody on the finance committee is in a townhome, so nobody benefited. The charts, assessments. The blue is actual, and the red is the budget is 2025 to 2028. Those are the assessments. And you look and they grow in a nice steady pace as we've grown, we've added units. As of 26, we're going to be full up. So the growth is just the rate of inflation, or as I told you earlier, the 4% assumption I put in to the model going forward. This is the chart that expresses concern. Any chart that you have that peaks out like this and then starts to fall off, and it is falling off, like a cliff. And why, and each one of these data points represents 12 months. So it's what we call a 12-month rolling average. So each data point represents the previous 12 months. And you can see in the forecast that this is just going to collapse. This is the capital contribution portion of it. Capital contributions, as I said earlier, 0.5% of every sale of a unit in this community. So we've looked with Veronica's intel, we've only got about 40 resales a year of existing properties. So when you look at 40 times an average selling cost, I used of $600,000 times 0.5% that drops our revenue to about $120,000 a year. So this is one of the big challenges we have and why we're looking at our forecasting tool to forecast up. You did notice in the numbers, remember as we went back, these numbers are in there. The lower revenue numbers from capital contributions are there, and it's showing us right now that we're not foreseeing a problem. Now we're going to talk about cash. Now this is one that brings a smile to everybody's face when there is some. As of 12/31, the community had almost $5.2 million in cash. Of that, 2.1 was in operating cash, and 3 million was in our reserve fund for replacement of roads, sidewalks, buildings, roofs, and things like that. I'm going to go through our cash investing policy. The fact that we have 13 individual investments in our operating account. We have 18 in our reserve account. Total of 31 line items or investments we're managing, and Marco Pella is managing as our major investor. He's our investment guy. And we're going to talk about interest rates too. First off, the PCA requires all investments to be in federally guaranteed accounts. This limits our investment options to Treasury bills and notes, bank CDs under the $250,000 limit, which requires us to have multiple banks, not just one bank, and money market accounts that are based on Treasury instruments. This adds a level of complexity. Mark is very good in building CD ladders. If you're not familiar with the CD ladder, it's basically investing in CDs with different maturity dates out. And last year, we earned $161,000 in interest income. That's a long way from where we were. I mean, anybody who looked at their investment accounts going back a couple of years ago were earning 0.5%. Well, the range is 4%. Right now we're in a very unusual situation in the economy. And that's because our short-term rates and our long-term rates are almost identical. We just got, our broker just informed us that we have a bank, we can get a bank CD, a 3-year CD at 4.1%. Well, guess what? My money market account that I have set up through Schwab earns 4.2%. There's no difference between a daily and a 3-year rate. This is an indication that the markets don't see, much, if any, rate declines in the foreseeable future. Cash challenges. Well, I've highlighted the cash challenges already. The reserve study, we do expect that to be a significant increase from where it's been because of the cost of materials. Right now, we're seeing cost of really materials for construction starting to rise. Things that you wouldn't consider. I have a client that does Corian, granite, quartz, surfaces. He does about $8 million a year. The problem is, we're looking at that, and guess where some of the product is made in Canada, so the consequences there. Some of the products made in the US, but all the raw material comes from guess where? Canada. So, we're looking at right now, we've got a danger, that one, we're going to get hit from all the past costs, but there's great uncertainty, at least in that marketplace, as to what the future, costs are, particularly lying around construction. The declining capital contributions. I think the chart, described that pretty well, that it's collapsing. It's coming. We knew it was going to collapse and go away at some point in time. The good news is, and maybe what I'll do is go back to one other chart to remind you that about, and I'm going to do that right now. Here, under service entrance, $243,000, and we generated an extra $245,000. There's almost $500,000 of cash. Now, we did have a huge amount of capital contributions in that year, similar in 24, but we spent $414,000 on a one-time event. Those aren't going to reoccur. So that's the one big positive we have looking into the future. We've been able to, absorb those costs without dipping into cash, of which, if I remind you, 5.1 million, 2.1 of it is in our operating funds. Our reserve funds are reserved for replacement cost items. The operating funds are not reserved for anything other than to support operations. So what I can say, in closing, that, we are in a great cash position. We have some challenges, particularly with the reserve study and what's going on here. But, I think financially, more importantly, we're healthy for the foreseeable future. I mean, in with our cash position and not having to dip into those cash reserves, operating and or, the reserve accounts. So with that, I'm going to stop talking and if anybody has any questions. I mean, we have people on our Zoom call too. So if anybody has any questions that we would be happy to answer.
Simple one. What is the period that's covered by the budget? The January 1 to December 31?
Yes.
And so how does then the assessment play into the budget? The assessments are done last year, if I remember getting my notice, and then go into effect, but you haven't done the budget yet.
Well, it's done at the same
The same,
time. The assessments are done after we complete the budget.
And
Okay, so the budget was approved last year for this year.
Yes.
Well, yeah,
So we're only seeing it now.
yeah.
No, the 2025 budget was distributed, and it's posted on,
At our annual meeting
presented at the annual meeting, sent out as part of the annual meeting notice.
in November.
And it is posted on the, there's copies here today, but it's also posted on the PCA Hub as well. So when the board approves the budget, they're approving the income and the expense all as one budget.
And where is the reserve? There's a reserve currently in place, the study done 21. Which I assume shows that you're gonna replace this road in 2027. How does that play through those budget numbers?
You see this number, $397,000? Right here, my cursor on that? No,
Probably not, no.
You know, $397,000. This line here, 90%. This
So other
is,
expenses.
this is the reserve, contribution.
The reserve contribution, not necessarily what we're spending
Right.
on reserve
That's the
projects.
contribution from the operating account to the reserve account.
So in this reserve study, do they break it out by year or simply say to replace a road every 20 years, it's gonna cost you X millions of dollars? Do they actually say that in 27 you should be spending X
Yes.
dollars?
Yes,
Yeah.
Yes.
yes.
Yeah.
By year and by component.
It's very detailed, although anytime we've had, something done that falls under the reserve and we look at what they reserve for, I mean, it's never even close, so whether over or under, I mean, so we'll go.
How far out does the reserve study go? It sounded like you were just saying 3 years.
We refresh it every 3 years. It goes out, I believe, 30 years.
30 years.
Yeah.
Yeah.
So question, as this capital contribution runs down, is it being considered to take a portion of the reserve fund and include it in your operating budget?
No.
Once you move funds into the reserve,
It's-
they're in lockdown.
Yeah.
That reserve fund is statutory required.
No, I know the reserve fund, because I'm not saying we eliminated the reserve fund, but every board I've been on, we take it, as it's grown, we end up taking a portion of it, it's like 4%, but it replaces an expense.
What
Well,
the board can do is, the interest collected in the reserve does not necessarily have to stay in the reserve. It's not a discussion we've had, but that is something that could be considered.
Think of Florida. A lot of condo associations fell into a lot of problems because they didn't fund their reserve,
No, I get the
reserve
reserve, I'm
accounts.
about that.
Yeah.
Like,
And remember what it covers. It covers 2 buildings and it's largely roads and open spaces,
The
yeah.
piers and the
Our
walkways,
piers.
What about the
Sidewalks.
swimming pools?
sidewalk.
No, that's
I
the
think-
club.
Hey, can I amplify?
Okay.
But Jack, just to follow up on that question, it's a very good question. We can't take money from the reserve to the operating. We could, although we never have done that, and we would. We could always reduce the contribution going from the operating to the reserve. You follow me? So if we decide that
It's just
there's
contrary to
too
what
much,
I'm
there's too much money in the reserve accounts. We could do that, but I don't, we've
At some
never done it,
point-
and I wouldn't expect it.
You didn't have that when you started.
You were next.
Yeah, just on that assessment line item, the top line, it looks like from the 2025 budget to 2026, that's about a 6% increase, but then it trails off to smaller increases.
Yeah. Well, we're going from 25 to 26, 26 forward. We're assuming we're collecting from 1,250 homes. 2025, we're not fully sold out.
Because you're still getting some of
Still
that.
new homes.
Right,
New
capital
homes.
contributions.
right. We're getting that, but we're not getting the assessment money yet.
So the assessment line item includes that capital contribution.
No, that's an other,
That's separate line.
that's a separate line. Yeah.
But until a home is sold and
But
settled,
remember-
we're not collecting the assessments from them. So the 2025 number is a growing number as each of our Stillwater's homeowners come on and contribute throughout the year.
Yeah, it's averaging less than 1,200 homes right now.
Yeah, a question about the front entrance. Wasn't that a truck that hit the
We're talking about 2 different things.
So yeah, we have Peninsula Service Road, which is our new service entrance. That is the expense that Jack was talking about that we've been able to incorporate that you see in the 23 and 24. The overhang at the front gate, which opened this week, is an insurance claim.
Yeah.
Okay.
I was confused about that. Can I go back to the reserve discussion, just because I'm trying to look at the more detailed printout and listening to the conversation, so. In this more detailed printout you sent out, the other expenses had like $379,000 reserve contribution. So that's a contribution that we're putting into the reserve fund.
Right,
We're expensing it in the operating budget.
right.
Correct.
Who pays to repair the road or replace the road? Does that come out of the reserve?
Yes,
Yeah.
Okay, so we are using the reserve,
So-
we're just
Yes.
not taking it into the operating. budget.
So the final paves that happened recently, in 18th on the Bay, Veranda and Conservancy, were done by the declarant. So it would be future,
Right.
But some of the places-
repaving.
20 years old,
Right.
and they're gonna
Right.
need to start.
I mean, a good example, in the veranda and in other homes, they did they sealed the cracks and all. That came out of the reserve
Okay,
account.
but the
Yeah.
reserve is used for those uses specified that the reserve is created to fund.
Yes,
But it's not you're not able to tap into it just to cover an operating deficit.
correct.
Right,
Okay.
Replacement versus maintenance.
right.
So your contributions every year were based on a certain number of homes, I don't know what the number was, 1256 or something like that. How does the fact that Insight wants to take two lots and combine them together, instead of getting a contribution for those lots, it might be instead of 6 lots, which I think they have available now at only 3, how does that impact the future years?
Well, it's 2 lots. I mean,
But are we going along with that? Do you have?
we had that's an OA. The declarant approved that for Insight to move forward and combine the lots.
Can I amplify that? There are other places in the community where 2 lots have been combined. There's one in Lakeside and one in Marina Bay, and they pay 1 lot. Most of our, but you didn't want to say, but I think you hit on, most of our expenses are per home. So the
Yeah.
only thing, so a lot of our budget is your trash. Cutting your grass, that's specifically per house. So the fewer houses we have,
Not really.
our number will be less. But there's a share of the common area that obviously will have 1424 instead of 1430, maybe sharing it, but the cost for that per house is minuscule.
Yeah, we went from with that change, we went from 1,253 units to 1,251. So it's on a large scheme of things, for our operating budget, it has 0 impact. Or maybe we're talking about pennies.
Hey, Jack, in our investments, how much investing are we doing in I bonds, inflationary bonds or anything like that?
I don't think we're doing anything in I bonds. No. Yeah, they don't fit into the profile.
Treasury bond.
Yeah.
Yeah, so that's secure. How is that interest tax? I mean, is it?
Good question, because it is.
What's that?
A good question, because it is taxed.
Yeah, that's what I was gonna say.
Yeah.
So there's an after tax, you say the number was very healthy,
Right,
but that's before tax. So there's the after tax. So
right.
I think we
Do we
pay,
know what that
I think we
effective
pay
tax
about
rate is?
15% to the federal government,
It's about 15.
just on the interest. So there's no,
No, I understand.
we're tax exempt otherwise, but on that
It's
interest,
about
we pay
50% tax, so it's really
15%.
about 85% of the number you projected that actually. ends up
That
taxed
net
in
cash
our
flow. Yep, good question.
Some of those federal
Well-
bonds have taxes.
Some of what?
Are taxes in.
Some of the investments.
Plus,
Yeah, so, yeah.
2%, so you're keeping inflation. It's a long-term line.
We pay a fair share. But
Hey, we've come a long way from a half of 1%. You know?
Some of the other taxes.
interest, we're gonna get the term of the bond.
I'm not sure.
I think they. Interest.
You had,
You mentioned earlier that OA said that Stillwater is gonna be done this year.
yep.
You believe that? So
There's some folks in here from Stillwater, right? Okay,
they're
So,
building like crazy. There's still 16 lots left.
so the window right now from the meetings with our friends at OA, are the end of this year through through with the final settlement possibly extending out through next summer, through the summer of 2026. That's kind of new news based on a slowdown in that they're seeing right now in sales over the last month or so.
Yeah,
So that's kind of the window that we're looking at is, I would say, November to June of 2026.
And historically, they have been overly pessimistic
Yeah.
with the budget, as you can tell.
Which is where we get
have
our,
blown
yeah,
through
the capital
our
contribution numbers from,
contribution
yeah.
budget for the last 3 years because OA was overly conservative about their numbers, which they have been. They have been, very conservative stewards of the peninsula.
and you said it was a 0.5%.
Half of one, yeah.
Yeah,
Any
100%.
opportunity to raise that going forward, since you're not gonna have a whole lot?
It would require an amendment to the declaration, so that would have to be a vote of the board decision, but a vote of the community as well.
Remember, it's 0.5% of what's been rising sales prices, so effectively the number's going up
Yeah, understand.
because of.
But,
prices.
and this is
Sales
why,
going down up there.
and this is the important reason why we're forecasting.
Capital fund to get that money, but now we're not gonna have it as much from the building anymore.
Exactly.
So you never, I assume, had an extra assessment for that, but do you project that that might come down the road if the house sales aren't as much and we're that?
I've been here 13 years. We've never had an assessment.
But you haven't had, because we've been building and you're dead.
Yeah, but, remember, we had those extra funds, from capital contributions in 23 and 24. We paid for the entire new service entrance out of those funds. Those really weren't standard operating costs. So we paid $700,000 out of, basically we used those extra funds to pay for that.
I think
And moving forward,
if you look, sorry, Jack, but if you look at Jack's projection for 27 and 28, we're about 100,000 in really rough terms, light of equilibrium, right?
Right.
If you take 100,000 divided by 1250, you're talking maybe 75 bucks a home.
Yeah.
So we're in reasonably good shape, I think, and unless we want to spend more money. And that's, I said that, I saw some people nodding their head and I saw some people saying no. So
and that isn't in our control. That's
No,
in Merrill
I
and,
don't know.
Mike's control, at some point, not now.
Please don't ask me to build any more roads.
But I can assure you, OA does not spend money, if anything, over the last couple of years, we've gotten them to loosen the, purse strings somewhat, on, landscape enhancements and things like that.
So other than the capital contributions going down, will there be any other financial implications of the community being built out?
Nothing from a negative point of view, no. It'll make it a lot easier for us to forecast it,
Yeah,
Right.
because the numbers don't change. You're gonna have 1,251 homes going forward.
Yep.
Anybody on Zoom with questions?
I was able to field most of the questions on Zoom. We had a similar question to the clarification of Peninsula Service Road versus the overhang, 2 separate projects, 2 separate funding sources. And I don't know about the expense for the HVAC units in the clubhouse.
Oh, yeah.
Not our problem.
Yeah, not our problem, Yeah,
In the budget under employees, L&M, are you direct, are you a contracted service?
We're a contracted service. We're called we're a pass-through employee. So are the expenses, we're dedicated here and you all pay all of our expenses to be here. Yes.
So that's the staff in the green building, it's you and.
Amber and Ellen. Yep.
Okay, and then do we have other employees?
security.
Security is a subcontractor.
Subcontract, pass-through?
Separate subcontractor. I think it wouldn't be considered, technically, I don't think it's considered a pass-through, or would it be considered a
No.
pass-through?
Subcontract.
Does that building ours?
PCA has no employee.
No direct
Okay,
employees.
so payroll
Right.
fees are.
Paid to like a Norman for the processing of our our payroll and our,
Payroll taxes,
and our
things like that.
ancillary.
That includes the payroll taxes.
Yes.
Yeah, we pay taxes.
Well, yeah, I don't
medical
think that line
benefits,
item
et cetera.
includes the
Yeah.
taxes.
No, but separate,
That's just the surface.
Usually.
Separately, there-
Administration.
Yeah, and we pay a fee for that. as well.
yeah, there is a separate fee that is just an administrative fee for the privilege of processing our
What says
information.
payroll fees are
Payrolls.
actually payroll taxes. What do you make here?
No,
Yeah.
those are,
No.
those are under the payroll line item. So if we're looking at this budget,
The
which-
payroll service items.
yeah, the payroll and benefits are separate from that. So the insurance and all of that falls under payroll and benefits, but separately as an administrative item, there is just a straight administrative expense that for the HR services, for the processing of it all.
All right, thank you.
I see on the utilities, the cable number is quite substantial. Are we getting value for that? We're new, so, and my only experience with Verizon is I've seen cables on the road ever since we moved in October. They don't seem to be able to, I don't know what the overall opinion.
Yeah, the
of Verizon is.
the Verizon contract, we really can't do anything about it for another 5 or 6 years. I mean, it was very long term. I mean, in the beginning, it was a deal and a half. I mean, as time has moved on, it's not as great a deal, but it's still a pretty good deal.
They did recently upgrade our speed to 100 over 100.
And
You may be looking at the expenditure, the cable expenditures. On the revenue side, there's an income line, which is offsets a significant portion of that expenditure, because that's what is coming through your home. So what you're seeing is a cable expense, as I say, is offset by a cable income line. Sure. The two-part
It's just a pass.
Oh, it's built into your assessment.
Are we happy with Verizon?
I think,
Are we happy with the service they're providing?
I think.
Yeah.
yeah, I think so. To me, the issue is we are bound to take both internet and cable, and society, as we grow and mature, people don't want cable anymore. They'd be happy just taking a YouTube TV or something else, but we can't do that for another 5 years. We are bound to pay for cable.
So it's 5 more years. on
And
that.
as Jack said, I think probably at the time.
I
it's
think
a
there's
hell of a
more than
deal.
5 years on the contract, but we have at that point in time, we'll be in a position, we'll be seeing the end of the light of the contract and can really talk to them. They're not willing to talk to us.
Sure.
You know, why would they? They've got a good contract and
They don't have.
they're not gonna change it, you know?
Yeah, the opportunity for that is to trigger a renegotiation at the same price, but to allow the flexibility so that homeowners could drop the cable and increase the internet speed. The price, then that where we're not paying a supplement for it.
Right.
Verizon stays cash whole, but we get flexibility in the process.
Well, in 5 years, when we put the committee together.
The same thing. We'll sign you up.
Folks want to learn a lot about the history of where we are in Verizon, how we got to a lot of the things. There will be another in focus group coming up in 2 weeks.
Let me check.
In focus,
April.
Merrill Cohen will take you through the history of our community. From the inception. Including Verizon. And the heartache, the grief, and now our wonderful pleasures. Okay? So look for that notice on the in focus meeting, and you will learn a great deal about the history. Merrill does a good job, and he doesn't charge.
Looks at.
Okay. Well, with that, one thing we want to thank everybody for coming, and caring and coming this afternoon. And for those who are still on the Zoom call, thank you for joining us. But hey, we're in good financial shape right now.
Well, thank you.
Hi, and
Committee will be here if anybody has specific questions for us.
Good job, Jack.
Or we keep
Well done.
speed at the bar.
Well done.